What would the potential tax hit be if you had 100% Covered Call ETF portfolio inside of a non-registered account, or otherwise known as a taxable account? Well, stick around for this video because I think it'll do justice when it comes to breaking the back of a myth that I think many of us Canadians hold, that you need to invest more heavily in Canadian stocks, Canadian ETFs to save the most on taxes. I know myself, I'm guilty of this. I've made videos about of investing much heavier in a taxable account with Canadian funds, but I've come to understand that it's just simply not the case. I don't actually need to do that, which is actually good news for us. It gives us much more variety, especially if it means that we can stick with a strategy we're more familiar with. So let's get into all that. Let's get into what the heck that you're even looking at here. What are my examples? And then what we're going to do is we're going to actually calculate the cost using a tax calculator that I found through Wealthsimple. That is nice, simple, easy to use. You can use it for yourselves. And I think it's probably one of the best easy tax calculators out there. So let's get going. So first and foremost, since we're talking about taxes, I myself am not a tax professional. Many of you know that. I am a pipe fitter, but I love talking about Covered Call ETFs and especially taxes. Many people don't, but I do. Okay, so a video like this is meant to inspire ideas and questions that you can bring to your professional or professional advisors or your tax accountants or whatever it might be. Okay, and to also give you an idea of just the reality of what this actually might cost you. So let's get into it. So what I've decided to do, one rule that I made for building a portfolio based on for our tax example here, is I picked funds that have been around for all of 2023. So no funds did I include that had only been around for a couple months. They needed to be, essentially their inception date needed to be December 2022 or prior, right? So that they were around for all 12 months in 2023. And I'm picking $150,000 because next year, for the newer viewers, who might be tuning in for the first time, I'm planning on exiting home ownership. I'm going to be renting a house, and I'm looking at around $150,000 of equity that I'm going to use to port into Covered Call ETFs and use that to offset the cost of a house rental for myself, my wife, and my 3 boys. So $150,000, that's why we're working with that number, just to give you an example of what we're looking at here. So I picked 4 all-in-ones: BMAX, HDIV, HYLD, and HDIF, with a few sector funds: BASE for mining, BKCC for Canadian financials, ENCC for Canadian oil and gas, and then we got a leverage fund, a leverage utility fund, HUTE, that is more global utilities. Anyway, so let's go through. Oh, by the way, and then I kind of made the all-in-ones a little bit heavier, $25,000 a piece, and all the sector funds basically got $10,000. So, by the way, all this information that you see here, you can pick up on my the Covered Call ETF AllStar tracker, which has a tax tab, which is where I got all this information from. I inputted this painstakingly back earlier this year, but anyway, it's great to have it because it makes constructing a spreadsheet like this so much easier. So you can pick that up on my Patreon, which will be in the description below, or in the pinned comments, and it's got a ton of other good stuff, right? It's got Canadian funds you can go through. You can go through all the American Covered Call ETFs, and then it's got things like tracking AUM. What does that look? Anyway, there's just a whole heap of information in there, and I think it's great for your Covered Call ETF investing needs. Okay, so since I got all this information from the tracker, and keep in mind that your distributions are broken down into eligible dividends, capital gains, other income, foreign income, and ROC, otherwise known as return of capital. Now, there is a section called foreign tax withheld, but I just omitted that. For the sake of ease, I'm not including that in this example. Okay, so for $150,000 with this partial all-in-ones with some sector covered call ETFs, what kind of yield are we looking at on the whole portfolio? So this whole portfolio would have an average yield of about 11.23%. That's right in the wheelhouse that I like talking about, between 10 and 12%. I say that because I think we can actually get some growth out of our portfolio, which is a main strategy of mine, especially within my TFSA right now, since I don't have a taxable account, which is invest in funds that look like that they have some growth potential on a price basis while getting an amazing, 10, 11, 12% yield in the process. Okay, so as we go along here, just to keep things really simple, when we add up all the eligible dividends across all the shares that we own, right? So we take $10,000 and divide it by the share price, we get 389 shares. We do that all the way down. What is the actual tax hit on all of these? So for eligible dividends, that's $1,708. Total capital gains that we would make on this kind of portfolio is $570.22. For other income and total foreign income, this is obviously going to be the least effective tax, not strategy, but just the, tax columns, right? So capital gains, much more tax favorable than foreign income and other income, and same with eligible dividends, much more tax favorable than these two here. Okay, these are going to get taxed at your marginal tax rate. When it comes to total other income on this portfolio, we're paying $1,147, and then total foreign income paid is $2,464.33. Now the total ROC we're paying is about almost $11,000. Keep in mind that the total distributions paid out on a portfolio that looks like this is $16,885, which makes the ROC by far the most tax favorable column here. Okay, so this is, you're not going to get taxed on the return of capital. There's lots of there's a lot of controversy around return of capital, but just so you know, this is a section that you're not going to be taxed on. So everything else, so $10,000 of the almost the almost $11,000 on the almost $17,000, you're not going to pay anything on. It's just these four totals that we see here. We see how much that we get total that's paid out. We see how much we're definitely not going to pay in taxes on. It's really just going to be this amount. So let's actually start plugging in those numbers and what are we actually going to get. So I've already gone ahead and done that. Now, for a portfolio like this, as we kind of back it up a bit, I plan to take this investment, this $150,000 from the sale of my condo, and put it in my wife's name. Now, she's a dual citizen, so we are not going to play with fire with the TFSA. That's going to raise too many issues with being a dual citizen of the United States. We'll put this in a taxable account for her. Bless her heart, she takes care of the kids, so she doesn't currently earn an income, but she'll start to with these investments, which she's very excited about. And just to say that that she'll be earning an income again is just fun for her to tell me about. With zero employment income, and we're only going off investment income here, I've plugged in those numbers. I've tallied up the total foreign income and the total other income, and you basically put that into the same they would be taxed the exact same, which is at your normal tax rate. So if you are wondering why there isn't a section for foreign income, you just add them together, and that should be totally fine for this example. Okay, and again, this is the Wealthsimple income tax calculator. You can put in your jurisdiction here. I put in BC because I live in a suburb of Vancouver. Okay, so we plugged in all those numbers. What is the actual tax hit? After tax income of $5,889, we're looking at 0, a big fat goose egg, which is great to see. This is what I'm talking about. I needed to do something like this, build something like this to actually see what the possible tax ramifications would be. So if I was to go with a portfolio like this on $150,000, that tax would be, basically be 0. Now, you know what I should do is actually plug this number into here, since these taxes are from this really only actually applies if your capital gains is above like $250,000. So if your capital gains is way under that, then honestly it shouldn't matter. It shouldn't matter whether you put in here or put in here, but going forward, you're going to be most likely putting it in here for, say, next year's income tax filing. We got our total taxes paid, $0. Great to see. What happens if we just play around with different income levels? Let's maybe start with 80K. At 80K, with nothing, just your employment income, if you were to make 80K, this is how much tax you're paying. So keep in mind, basically $19,000. Now, if we include employment income and you had that same portfolio that I was talking about, so we didn't change any of the numbers, and you live in BC. Again, going down the list here, so we changed nothing. You're basically paying $1,000, I guess, extra in taxes, $1,100, with receiving basically $16,000 in distributions, which, what would that be? Paying about $1,000. That's got to be what, 6%? Like an average tax rate of 6% on your investment income. That's phenomenal, and that's not even in a tax favorable account. So let's maybe change up the numbers and same portfolio, but we'll go maybe do 100,000 and see what we get. Okay, so $24,759. Let's go one. Nope, I'm not doing that. So at 100,000, so what's the difference here? We'll call it $1,300 if you have a $100,000 income and you have a $150,000 Covered Call ETF portfolio. You know what? Let's just go even higher. Let's do 125. See what the difference is. I encourage you, if you're going to play around with these numbers and you're going to do something similar to what I'm doing here, I would encourage you to open up just like a couple of different tabs so that you can kind of jump back and forth instead of input one number and then erase everything or delete everything, then put the numbers in again. This is probably just the easiest way to do it. Okay, so at $125,000 income, you'd be paying what, $33,445 in taxes, and then with the investment income, with $125,000 employment income, you're paying like what? It's like $1,700 more on that investment income. So really tax favorable. I think this just kind of goes to show you don't necessarily have to invest so heavily in Canada to save on taxes. I think this kind of does breaks that myth in many ways. So going forward, I don't know that I would strictly only invest in ENCL, UMAX, and bank like I've talked about in prior videos. I certainly will include those. Those are definitely going to be part of my strategy going forward, especially to get probably a higher yield, I would imagine, especially to offset that house rental. I think I would say tentatively I'm probably going to want to be more closer to 14%, but I still want to get a little bit of natural growth out of it. So hopefully you all liked this video, and hopefully it did a good job of giving you guys some ideas around taxes. Obviously, if you have any questions, throw it in the comments below. And as always, hit all the buttons of like and subscribe variety, and I'll see you all in the next video.